the Fed's rate cut, and what you need to know. That's what we're going to cover in this monthly market report. This is for you if you are a real estate agent, a financial advisor, or an attorney interested in market data to help you advise a client. Or perhaps you are that potential buyer or seller looking for some direction. I'm Paulo Rodriguez. I've been a mortgage professional since 2005, and here is the market data that you need to make an informed decision or help your client do the same. The Federal Reserve has finally cut their benchmark interest rate, and it comes as no surprise because they telegraphed it pretty clearly in late August. But there are a lot of misconceptions as to what this exactly means and how it affects us. So every time the Fed meets and changes the Fed funds rate, it's important to talk about what we can expect next. The most common misconception is that the Federal Reserve sets mortgage rates, and therefore, because they drop rates by 0.25%, then mortgage rates should be lower by 0.25%. And that's obviously not the case, because the Fed funds rate is the rate at which banks lend money to each other overnight, or in other words, a very short period of time. That should not be confused with mortgage rates, which are long-term interest rate products that can extend as far as 30 years into the future. Short-term interest rate products such as credit cards and home equity lines of credit are directly impacted by the Fed's fund rate, but not mortgages, at least not directly. So what's the connection then between the Fed lowering their Fed funds rate and mortgage rates? Well, the connector between the two is inflation. When the Fed moves their rate, the market has to assess if that will accelerate or decelerate inflation. If the market determines that the Fed is not too loose, meaning the Fed's funds rate is not too low and is well positioned to keep inflation under control, then that would be a good thing for the bond market and therefore a good thing for rates. However, if the market determines that the Fed is too loose or too dovish, which means not very restrictive in that they are willing to drop rates more than they should, then that would be inflationary, and inflation erodes the value of money over the long term, which means that mortgage rates would go up. Why? Because most mortgage rates are bundled together in hundreds of millions of dollars and purchased by very large institutions who want to earn a decent interest rate that is secured by real estate as collateral. These are called mortgage-backed securities, or MBS. Now, if I'm an institutional investor who wants to buy $100 million of MBS, but inflation is out of control, then it's safe to say that the relative value of my $100 million is going to be eroded over time by inflation. Therefore, the higher the rate of inflation, the higher the interest rate I would want to receive in exchange for paying for $100 million of mortgage-backed securities. I would only be willing to buy if I was paid an appropriate rate of return that not only covers my costs and allows me to make a profit, but also protects me from inflation. That is why rates go up when there is accelerating inflation, and that is also why rates go down when inflation is receding. So you might be thinking, okay, the Fed dropped rates, and based on what you just said, that's inflationary, so mortgage rates are going to go up, right? No, that would only happen if the Fed was too loose or too dovish. Dropping the rate does not imply being too loose. As a matter of fact, there are many people that think the Fed is still too tight and that we need another 1 or 2 rate cuts before the end of the year. Historically speaking, for the most part, mortgage rates have gone down after the Fed has lowered the Fed funds rate. And this is because the lowering of the Fed funds rate has coincided with periods of receding inflation due to economic slowdown and or a weak job market. So what do I think is going to happen? I think that we have for some time been in a rate reduction cycle, and this now serves as confirmation that we have more to go. Do I think it's going to be a quick drop? No, I don't. I think it will be a gradual drop. Average mortgage rates will likely still have a 6 in front of them for the rest of 2025. But I do think that they will gradually find a resting place somewhere in the 5s. Do I think that we're going to get back into the 3s? No, I don't. And I seriously hope not, because if we were to get that low, that would imply serious economic trouble and on a global basis. Moreover, I believe that in the next decade, we are going to see the largest jump in productivity we have ever seen. And I say that because of where artificial intelligence is currently at. Its growth will only be exponential and will dwarf the increase in productivity that we saw from the surge of the internet. Increased productivity would imply economic expansion, and that is not deflationary. So while rates have lower to go, we're not talking orders of magnitude lower, which makes it important for potential home buyers and those looking to refinance to have a hard look and truly assess the cost of waiting. If you're looking to purchase a home and you are holding out for better rates tomorrow, you're doing what everyone else is doing. And in the end, we'll end up paying more for a home in terms of price, which is more expensive than paying a lower price today, but accepting a higher mortgage rate that can be refinanced in the future. It's a case of as the saying goes, marry the house, date the rate. On the other hand, if you are a homeowner that already made the smart decision to buy a home to avoid competition from other buyers and are now looking to refinance out of a high interest rate, you too have to assess the cost of waiting. You have to think about what it's costing you to not refinance now and how much holding out makes sense. I invite you to have a conversation with me to discuss your strike rate, which is the rate at which it no longer makes sense to do nothing. How much lower this rate is different for everyone because it's also a function of how long you intend to stay in the home and whether or not it makes sense to consolidate higher interest rate debt. I hope that I have simplified and clarified what the Fed dropping rates means to you and that I've given you some direction. That's a wrap for the October market report. I appreciate you listening in. Forward, subscribe, share. I'll be back next month. But before you go, if you're looking to purchase or refinance or know someone that is and would like a no-cost consultation with me personally, feel free to reach out and I'll be happy to analyze if your debt is structured in the most optimal way or if there's room for improvement. Thanks for watching. Bye for now.